Mr. Coffman.
Thank you.
Thank you, Madam Chairman. Mr. McGannon and Ms. Blankenship, I get complaints from my local bankers and from my small businesses, well, particularly from my local bankers, who say that on one hand the federal government wants them to lend, and on the other hand, I think just the regulatory scheme is such that it's kind of the zero defects, that they had a 20% increase, I think, in their capital reserve requirements, if I'm using the proper term, 10 to 12%, and that has caused them to pull back on their lending. That, I mean, have we gone too far on the regulatory side where we're not allowing bankers to exercise their own judgment in terms of the ability of the borrower to repay the loan? I mean, could you address that issue? Ms. Blankenship, we'll start with you.
Certainly. Again, we can't be painted with the same brush. And, yes, has the regulatory burden gone too far right now? Yes, it has, because you find banks are hesitant to lend because of the increasing costs that I talked about. The FDIC, we're additionally being asked to put more money in loan loss reserve. So that takes the money out of loans, money available that could be leveraged back into loans. So all of those are challenges right now. To make this program more effective, we have to continue, as I said, to look at the initiatives and what's working, and get back to less paperwork and involving more banks in this program. Additionally, if we could get some Subchapter S reform, you'd find that a lot of small businesses could raise their own capital. Right now they're restricted to one type of stock. If they could be allowed to issue preferred stock and increase their shareholders. So I think there's many ways that we could approach this, but again, to really answer your question, the regulatory environment, until we can get some equity there and know that the way you supervise a too big to fail bank is not the way you supervise a small business bank, which is what we are.
Okay.
We realize the regulators are under a lot of pressure, and I will say that our examinations are more difficult, but I continue to think that they are fair. We spend more time discussing our borrowers, as I mentioned earlier. Even though they're performing well, they are going through several more layers, I think, in our portfolio. And again, I can only speak to our bank. But they are fair. They just want to learn as much as they can about what our borrowers are doing and how they're performing. And again, I certainly understand that.
Would anyone else like to comment on that? Yeah.
I would just like to say, from a credit union perspective, we've been heavily regulated for many years on business loans. Tremendous amount of regulation. But having said that, so far our examinations have been fair. I've heard from other colleagues that maybe there's not that kind of consistency. Other areas of the country, the examinations are very difficult, and it's maybe kind of anti-business lending philosophy on the part of the examiner.
Would anybody comment on the fact that I often hear that the other shoe is going to drop, and it's commercial, the exposure to commercial real estate? And what will that do to lending? Is that going to further tighten it up? What's your prognosis of the future here?
We are concerned about commercial real estate, but I think just to make the distinction, commercial real estate covers a lot of different types of property. When we think about commercial real estate in terms of owner-occupied commercial real estate, where a business owner owns his or her building, we continue to have confidence because it all hinges on how is his or her business doing, how are they performing. So the collateral truly is secondary in nature. But commercial real estate in terms of hotels and multifamily and those types of things, we're concerned about where cap rates are going, where appraised values are currently, and certainly there is a watchful eye toward that part of the market.